IRAs are a well-established tool to help fund retirement accounts due to all the tax advantages they offer, but one major drawback for some people is the fact that if you have an unforeseen circumstance and have to withdraw from your IRA before the typical retirement age of 59 and a half, that you're going to be hit with a 10% penalty. In the case of a traditional IRA, you would also have to pay income taxes, and in the case of a Roth IRA, you would still have to pay taxes on the earnings earned on that account. So it kind of ends up being this double whammy. You get hit on the tax side as well as this penalty side. However, there are some exceptions that are allowed in special circumstances or for certain purchases using an IRA. Obviously, ideally, you would end up funding a retirement account and never touching it, but sometimes you end up in a bit of a financial pinch. So being able to withdraw from that IRA without paying that 10% penalty can be a huge help. So without wasting any more time, hit that subscribe button. Here's several ways to withdraw early from your IRA without paying that 10% penalty. Now, the first on this list is great because it applies to just about everybody. You may not have known this, but you actually can use an IRA account to help purchase a home. You can actually use $10,000 for an individual or $20,000 for a couple to actually purchase or actually build a home. As long as it's a purchase for a first home, you could end up avoiding paying that 10% penalty. Now, this pretty much applies to every single method I'm going to cover, but the reality is you're still going to end up owing taxes on that early withdrawal amount. In the case of a traditional IRA, you're going to pay income taxes on the distribution amount because you didn't necessarily pay income taxes from the beginning. In the case of a Roth IRA, you were taxed in the beginning, but you will be taxed on the earnings that you're going to end up having distributed. Now, to qualify for this exception, you must not have owned a home for the previous 2 years, and it should be noted that you could potentially end up using the same methodology to either pay for a parent or for a child or even a grandkid or grandparent. Now, it should be noted that if you end up taking funds out of your IRA and had the intent of purchasing a home with it, but for whatever reason it ends up getting canceled or delayed or your plans end up changing, as long as you take those funds and put it back into your IRA within 120 days of the day that you withdrew it, then it will pretty much be like as if you never did withdraw it and that you won't end up paying that 10% penalty. Now, this next exception applies to anybody that plans on being a parent or is already a parent. You can actually end up withdrawing from your IRA and actually using it to pay for someone's vocational school or college or university. And you may be thinking to yourself, isn't a 529 plan a better option? And the reality is yes, and I will be covering that in a future video as far as the advantages of a 529 plan. But there are two main reasons why I mentioned this, and they both relate to the fact that most people don't end up funding a 529 plan unless they're absolutely sure that they're going to have kids or absolutely sure that they're going to end up trying to pay for their kids' college or university. The first instance I can think of is, let's say you end up at a dead-end job, and no one necessarily plans on ending up at a dead-end job, and you weren't necessarily planning on going back to school either. And if you don't necessarily have the funds available to go back to school, but you do have enough funds in your IRA to help fund and actually pay the beginning parts of the tuition to be able to go back to school and move on to a different career path, this actually would end up being a great option to avoid that 10% penalty. The second, much more real instance for a lot of people is, let's just say you never got around to funding a 529 plan, and now you have kids about to go to college, and you end up realizing that you're sitting a little bit more comfortably than you thought for your retirement funds. And so now this is a great tool. You can actually withdraw early from your IRA and not pay that 10% penalty to help fund your kids' college education. Those are just two brief examples, but at the end of the day, the purpose of this video is to basically incentivize people to help fund their own IRAs, because a lot of people don't end up liking their funds tied up into something that's going to be, 30 years down the road. So knowing that there are these ways to basically withdraw it early without that 10% penalty may incentivize some people to actually end up funding their own IRAs. To be considered an eligible college expense, it needs to relate to things like tuition fees, books, or things for classes, but it could also relate to things like board or rent, and the person it relates to needs to at least be at a minimum a half-time student. So I suppose it's probably some kind of weird way where you could end up retiring early at a university and end up avoiding that IRA penalty. But the reality is, in all seriousness, you can actually use these funds for a college, university, or even vocational schools. It doesn't necessarily have to be an actual university. And on top of that, you don't necessarily have to, if you're the account owner, you don't necessarily have to use those funds for your own college education. You can actually end up using it for either a parent, child, or grandchild. However, it should be noted that these IRA withdrawals end up being taxable income and may end up impacting the student's financial aid. Another way you can end up avoiding this 10% penalty is if you have a huge medical expense that's not necessarily reimbursed. You can still end up having insurance, but if the amount that's not reimbursed ends up exceeding 7.5 of your adjusted annual income, then you can actually use your IRA to help fund these medical expenses penalty-free. Now, obviously, I hope none of my viewers end up having to use this, but that's the whole reason for this is that medical expenses are unexpected, and that being able to withdraw from your IRA penalty-free can be a huge help. Now, just to be clear, it's only the amount that's in excess of 7.5% of your adjusted income. So let's say, just to simplify it, that your annual income is $100,000 and you end up having a medical expense that's $10,000. So it ends up exceeding 7.5%. But the first $7,500, that needs to be paid either through other means, or you can still end up using your IRA to help pay those medical expenses, but it won't end up avoiding that 10% penalty. But the amount that's in excess of that 7.5%, so that $2,500 that's remaining, can end up being paid and end up being penalty free if you end up using IRA. And if you're confused about this at all, feel free to comment down below, or you can contact your IRA administrator and they should be able to calculate and know to the exact amount how much you actually can use for your IRA and still end up paying penalty free. Now, this may come to a surprise for a lot of people, but the reality is the majority of people actually can withdraw early from a Roth IRA and still end up avoiding a penalty. The reality is Roth IRAs end up having less restrictions and less penalties related to them. Now, I did say the majority of cases, not necessarily every case. This is because you need to have that Roth IRA for at least 5 years or more. If you've had it for 5 years or less, you're not necessarily going to avoid that 10% penalty. I also should note this is related to Roth IRA contributions, not necessarily any type of investment income you've made off of that account. So let's say I end up depositing $1,000 into a Roth IRA and ends up sitting there for 5 years. In 99% of the cases, I'm not necessarily going to promise anything here, you're going to be able to withdraw that $1,000 penalty and tax-free because you already paid the income taxes from the beginning. Versus a traditional IRA, the rules are a little bit different. You're using pre-tax dollars. So with a Roth IRA, you would be able to withdraw that $1,000 penalty and tax-free. But let's say that $1,000 ends up growing by $100 just because of interest rates. That $100 you wouldn't necessarily be able to withdraw penalty free. If you did end up withdrawing it early, you would be penalized on it and you would have to pay taxes on it. Now, these next examples aren't necessarily as common, but they are helpful to know because perhaps you have a friend or family member that it actually applies to. If you end up in a situation due to a mental or physical condition where you can no longer work, you are able to withdraw from your IRA penalty free. Obviously, you're going to have to provide documentation and pretty much guarantee that a physician is going to have to come and confirm your eligibility. But should you qualify for this penalty-free exception, then it pretty much ends up allowing you to withdraw from your IRA for the duration of the condition or for the rest of your life. Now, this next one is actually recent. As of 2020, parents of newborns or people that are adopting can actually withdraw up to $5,000 from their IRA penalty-free as long as it's within a year time frame from when the child was either born or adopted. Now, if you don't end up needing those funds like you thought and your financial situation improves, you actually can take those funds and put it back into your IRA. Now, another possible exception is if you are a member of any of the military reserves and you end up getting called to duty and you end up having a period of 180 days or greater, as long as you end up taking the IRA distributions during your active service, then you actually can avoid that 10% penalty. Now, another possible way to avoid the 10% penalty is having an IRA distribution set up as a series of annuity payments, and it has to be an IRS approved plan, but the reality is usually most people end up finding this a little bit complicated and you end up having to work with a professional to actually make sure that you're getting the right calculated amount, because if you end up withdrawing even just a little bit too much on this annuity, you can actually be subject to more penalties. Now, another possible situation is if you end up inheriting an IRA either from a parent or grandparent, you can actually make withdrawals from this IRA penalty free, but you still will be subject to income taxes on this. However, it should be noted that if you end up having a spouse's IRA inherited and you end up electing to basically treat it as your own, you will be subject to penalty if you end up withdrawing before the typical retirement age. I'm sure there's a bunch more obscure random rules on how to withdraw penalty free, but I wanted to stick to the majority of the ones that are applicable to a lot of people. Now, if you appreciate this video at all on a real way, this isn't necessarily a glamorous personal finance topic, but it's a real way that ends up saving you at least 10% penalty, that ends up saving you money. So if you appreciate that at all, please give this video a big thumbs up. It'd be a huge help to me. And if you want to consider subscribing to this channel, I want to do a better job on focusing on topics that actually end up saving you money and actually, you're actually learning something versus just kind of glamorous headline type topics, stock market crash type videos, those types of things, which I'm guilty of as well. But I want to stick more on how to actually, teach you how to open up a business credit card or how to hit those sign up bonuses, how to buy your first home. turnoff.com. Those different types of topics. If those interest you at all, please consider subscribing to the channel and feel free to comment down below, ask me questions or even future video ideas. I'd greatly appreciate it. And as always, I hope to see you in the next one.